Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Key data on the way from China may show the economy failing to turn the corner, with consumption looking to remain quite sluggish, of course, for the month. The central bank expected to also hold its one-year interest rate steady. We'll find out, of course, in a couple of minutes. Now, cautious trading across the region here with stocks so far. You have soft U.S. inflation data barely moving the needle on Fed rate cut expectations. And shares of Tencent in focus with earnings fueling hope of a gaming rebound, but also reflecting pressures from a slowing Chinese economy.
I know we're usually busy, but today is a busy day, I have to say, actually, just given what we've been seeing. Of course, reaction from that U.S. inflation print, as Dave mentioned, didn't really do much in terms of moving markets per se and what has been already been priced in. But then again, it was a calmer CPI that did calm that market on the U.S. session there. But we're still seeing stocks catch a slight bid here this morning. You take a look at how Taiwan is opening up as well. It's pretty much flat right now. But really, there was little change in treasuries, little change in the dollar as well. Swaps are basically fully pricing in that 25 basis point cut in September now, 4 cuts through the end of the year, which includes, if you think about the calendar, there's going to be one meeting where they're going to have to do something that's 50 basis points. And it seems like the market has a little bit more confidence around that sort of scenario now. U.S. futures are pointing positive. We're watching commodities very closely. So right now we're back below $80 for Brent. We saw basically some of the Middle East sort of angst around the oil markets kind of ease a little bit here. But iron ore, we saw a further slumping here this morning of 1%. But we're back to the lows that we've seen about 15 months ago. This is when we heard from the Baowu Steel Group chair warning about a steel industry winter in China and saying that the crisis is more serious than downturns as he's seen back in 2008, 2015. We'll talk a little more about that a little bit later on the show. We're talking about what happens here. Obviously, there's a lot earnings on tap. In China, we talk about Tencent. We talk about Alibaba. JD.com is coming up next. But then again, we also have that data dump to contend with as well in just a few minutes or so. But there you go. Nasdaq Gold Drag did this right now. Tencent ADRs did fall some 3%. We talked about it was a blowout number when it comes to games, but the fintech business only grew about 4%. So we're talking about that macro weakness and how it's weighing on that part of the business. It certainly may lead to maybe some weakness in the stock here today. Futures are pointing negative here. We're talking about 218 for your 10-year yield and 715. But, yeah, the CSI 300 still can't really catch a break right now, Dave.
No, lowest since Feb 5 on price. Volumes lowest of the year on Wednesday. Turnover overall in China has continued to fall to, I think, about a 5-year low as far as that's concerned. So, yeah, as Yvonne is pointing out, it's busy. Let's start with we're working in 30-minute increments here. So we have a rate decision in about 18 minutes or so. We have property prices coming out. Bottom of the hour, top of the next hour, then we have this massive dump of data coming through as well. On top of all this, as well, as Yvonne is pointing out, this rout we're seeing in the metal space. And then just to add to the commentary coming out of Baowu Steel, Citi just came out and added Baoshan Steel, Angang, and Ma'anshan Iron Ore to a 30-day catalyst downside watch there. So we're watching that group very closely today. And as far as earnings goes, so Tencent we're looking at reaction. And likely going to see a 2-3% drop is my guess in the opening minutes. Baba's on deck, JD.com, Lenovo, Galaxy Entertainment, so a very nice cross-section of industries, and China Telecom, Unicom rather, is also due out with results later today.
Yeah, to our top story still, it is that U.S. inflation print that did kind of ease some concerns out there. Here's what our guests have been saying out in the U.S.
We're moving in the right direction.
I think it's pretty good news.
The economy is still strong. Inflation is decelerating, and full steam ahead for the first rate cut on September 18th.
If they want to cut rates, they're probably going to cut rates in September.
The market is leaning towards 50.
I don't think anyone should hold their breath for 50 basis points.
If they do a 50 basis point cut, it will probably spark an unnecessary concern in markets that they know something that we don't know, or something's happening in the economy.
We think 25 is the right first step towards easing policy.
Our base case remains for a 25 basis point rate cut in September.
If I'm the Federal Reserve, I want to try to get back to normal here, because the risk of recession, I think, is greater than the risk of any resurgence in inflation.
And Mark Cranfield is with us today out of our MLive team in Singapore. Mark, so we had let's call it a decent CPI print, not too cold, not too hot. Can we just make that final assumption now that the Fed will, in fact, cut interest rates next month?
I think they're in a position where if they don't do anything in September, the risk of a market fallout is very great. We could get something like we saw in Japan last week. When a market is so firmly priced for something to happen, traders are actually, if you look at the way the derivative curve goes, traders are actually pricing for up to 200 basis points in rate cuts by the end of next year. So they're seeing rate cuts all the way, every single Fed meeting between now and the end of 2025. Now that is probably overdoing it, but it tells you how much money is committed into expecting the series of rate cuts to begin in September. Every asset class is now fully pricing for that. So if the Fed doesn't do anything, the market reaction will be extreme. There's no question. With that much money already in the market, there will be a huge fall. The Fed is aware of that. They don't live in a cave. They understand the real world. They can see what's going on. They will deliver a rate cut to satisfy what the market is looking. And of course, the data justifies that anyway. The question now is still whether it's 25 or 50. There is still room for people to push it towards the 50. We still have a very important employment report. And we had another Fed speaker overnight reminding everybody that it's the change in employment, not the inflation situation, which is worrying the Fed now. The cracks are beginning to appear, and they're coming quite quickly. That jump to 4.3% in the unemployment rate took people by surprise. It may go a bit higher again. Clearly, that one is much more sensitive now than what's inflation is on a nice path. It's on a trajectory that they see. It hasn't really deviated very much. We're going to get PCE numbers later this month that will confirm that 2% is definitely on the horizon. The Fed is doing the right thing. It's the employment situation which possibly could get out of hand. If we get a weak number, the 50 basis points cuts will definitely be back on the table.
Yeah, and certainly there's going to be a lot more focus on labor market data, retail sales coming out later on today as well, Mark. Everyone's still trying to call the kind of this downturn of the dollar. I mean, how do you see currencies playing out when the Fed starts cutting rates?
Well, there's a big shift already taking place, and it's probably the next story in the currency market is really the euro. So we had all the activity related to the yen over the past few weeks. That seems to be cooling down now. But in order for the US dollar to be uniformly weak, which is starting to happen, we can see the Bloomberg dollar spot index is already towards the lows of the year. That's incorporating emerging markets as well. There's a general sense that the Fed situation is fairly known. That's causing pain to the US dollar. It will go on for some time. If you look at cycles for the US dollar, they tend to be pretty long. It looks as though we're beginning of a downtrend for the US dollar, but the key factor is always the euro. The euro is the currency which prices all the Asian currencies, it prices the Latin American currencies. Really, it's when the euro gets ahead of steam, that's when the dollar really suffers, much more so than the Japanese yen. And that's beginning to happen. The euro's 110 area, if we go above 111, that will make new highs for the cycle, and then people will take it very seriously. And it looks as though the Fed might even need to cut faster than the European Central Bank. So the euro is very much in the picture, and where it goes from here will determine the whole dollar complex. And it looks as though the dollar is in for a long period of weakness.
And would that be good for equity markets? Mark, let me circle back to your first point that, we have almost a cut price at every Fed meeting from now until the end of next year. And that seems to be, priced to the very brim of the, that glass. And I wonder, it's similar to the situation we were in at the start of the year when we had 6-7 cuts. And then when markets started to price out some of those cuts, equity markets started feeling the brunt of it. We're up 5 days in equity markets today. When markets start looking at that cut at every meeting and say that's a bit too much, do you think equity markets will again be in the firing line here, Mark?
Well, the offset to that will be the stronger Asian currencies. We're beginning to see already that Asian currencies are picking up some traction. That will probably continue. That's a positive for regional markets. The flip side, and the thing that will concern investors, of course, is things like the tech story. Is there enough steam in the AI narrative? We'll get a much better read on that when we get NVIDIA results next week. They'll want to see that Asia is still going to benefit from the global AI story. If we get confirmation of that next week and we get stronger Asian currencies, we might get a continued decent run in the Asian markets. Korea is looking like a place that people like, Taiwan as well. Japan is beginning to find its feet. People can probably put China to one side. It's becoming very much a local market, and there's a risk that will go on for a long period. So as people get used to the idea that it's Asia ex-China, it can probably stand up pretty well, providing that there's enough support from a weaker dollar and the interest rates are going in the right direction. But the AI story does need to fit in as well. We do need something positive from NVIDIA next week.
Mark. Thank you, Mark Cranfield, our MLI strategist, joining us out of Singapore. What's next on tap is really the data dump that's coming out of China. So activity data out from July, just a few hours, looks likely to show, well, I should say, in about an hour or so. It's about to show that the economy basically has failed to turn the corner on its worst stretch in 5 quarters. For more, our China correspondent Min Lo joins us with a preview so far. It looks like we're not going to see anything change too much from what we saw back in June.
Yeah, we continue to see this two-track recovery with retail sales performing more badly than the industrial production. Retail sales expected to grow by 2.6%, slightly better than the previous month, but overall still very sluggish. If you look at pre-pandemic levels, retail sales was at about 8%. We are far from those numbers now. This month's retail sales are improving because of the summer travel season, so more demand for services, but not so much for goods, though. If you look at sales of cars, which make up 10% of retail sales, that's down for the month of July. Industrial production expected to grow 5.2%, slightly slower than the previous month. This is the 4th consecutive month of industrial production growing at a slower pace. And again, some worrying signs there because we did see that Caixin manufacturing PMI contracting for the first time in 9 months, pointing to headwinds when it comes to export demand and a slowdown in the U.S. economy as well. And then fixed asset investment that's expected to remain flat at 3.9%. This is where we see the government speeding up the issuance of the local government special bonds to inject more infrastructure investment to make up for the shortfall in private investment. And we have property investment still looking not out of the woods yet, negative 9.9%. The PBOC plan to inject the 300 billion yuan in relending facility, not seeing a huge take-up rate now.
Speaking of the PBOC, in a couple of minutes, we have a rate decision coming through, 1-year financing rates. They moved, of course, off cycle a couple of weeks ago. What are we expecting there?
Yeah, so they cut by 20 basis points in July. We are expecting the MLF rate to remain steady at 2.3%. There is some speculation about whether the PBOC will actually delay the MLF rate announcement to the 25th again. But right. Our Bloomberg Economics team thinks that was a one-off event. They think they're going to hold rates steady. We think that there will be another rate cut towards the end of the year, but not until the 4th quarter and probably not until the Fed cuts first. And also, remember, you have this battle with the bond traders. You got to think if they cut the rates, what's going to happen to the yields again.
All right, Min, thank you. Min Lo, our China correspondent there, on what to expect, of course, with that MLF about a few minutes away, home prices at the bottom of the hour, and then 10 o'clock local time, you're going to get that activity dump. Ahead of that, though, we're speaking with economist Keyu Jin about why she sees politics instead of structural issues that is hindering growth.
Yeah, but ahead of that, we'll be in the thick of China earnings. Of course, Tencent reported, Alibaba's on deck, and CLSA joins us to talk us through those big companies. The opening bell 16 minutes away. You're watching The China Show.
Sorry. Your renminbi fix just crossing the Bloomberg, and it is a little bit stronger than expected, actually. 713.99. I believe that's it's been a while we've seen actually one that's below that 714 handle here. But we right now continue not seeing that much change in the currency. We're still hovering on those 715 levels ahead of a lot of stuff happening in the next few hours.
Oh, yeah, can't hardly wait. One of the things we'll be tracking, of course, in a couple of minutes is what Tencent does in the pre-markets. If you judge it by the 3 or so decline overnight. We'll probably see some downside in the opening minutes here for Tencent. As you can see, down 3%. Latest results, of course, showing pressure from the weakness in the Chinese economy. Good gaming. Fintech was a bit of a miss there. Let's bring in Elinor Leung, Head of Asia Telco and Internet Research at CLSA. Elinor, good morning. Your overall take on these results from Tencent.
Hi, good morning. We actually think the Tencent second quarter result is quite solid. If you look at the online game, we see a nice rebound, and online game revenue will grow at 9% year-on-year in both domestic and international market. The gross receipt is growing even much faster compared to revenue, driven by the revived growth of the legacy game as well as the new hit games. So in China, DNF Mobile become the new #1 game in China. Quarterly grossing will likely be around 5 billion RMB. Peacekeeping Elite also regrow at double digit with new themed outfits as well as new shooter modes called the Metro Royale. Overseas grossing is growing even faster given the strong performance of PUBG Mobile as well as the enhanced performance of the Supercell's game, especially Brawl Stars. We see Brawl Stars grossing is up 10 times year-on-year. Supercell's also launched a new game called Squad Buster, which gained a critical mass in the Western market. Valorant also ride on the new esports events there. If you look at the advertising, it's also growing at 19% despite the weak consumptions. They see special strong demand from game e-commerce as well as education. That's driven by tech enhancement as well as video accounts.
Elinor, can you tell us, how sustainable do you think this strong gaming growth is going to be as you look into the second half? And is it still going to be enough to offset some of the weakness that we saw in these earnings, particularly when it comes to fintech and cloud?
We expect the gaming revenue growth is going to accelerate in the second half to double digit from 9% because the growth in revenue now is growing much faster compared to revenue that is capitalized and amortized over the next few quarters. So the revenue growth actually is going to accelerate in the second half. But you are right, the weak macro is going to weigh on advertising growth as well as fintech business service growth in the second half. But we're still looking at around 9-10% top line growth, and their margin in a structural upward trend because the new revenue has much better quality right now. So the bottom line growth is still going to be much stronger compared to top line. So we still expect that Tencent deliver better results compared to other Chinese companies.
Yeah, Elinor, you make a good point. The gaming business is doing well despite the slowing macro. The slowing macro, to your other point, is being felt in the fintech business. Do you think Tencent is a counter-cyclical play? You think as an investment play?
Gaming definitely is counter-cyclical. It's more hit-driven rather than consumption-driven. As long as you have a hit game, you can see that the new DNF Mobile is still attract 5 billion RMB grossing a quarter. So it's more of a hit-driven games. And Tencent last year's game is a little bit transition phase, and now this year they have a couple of big hit game coming up and very successful. So we think that is a counter-cyclical. Even the advertising revenue is going to slow in the second half. We still think that is going to outgrow the industry because they have a couple of the catalysts which is within Tencent. One is the advertising technology upgrade, which now they're able to analyze user data over years instead of months, which they have more deeper insight in terms of the user behavior and can recommend better ads to the user, increase the click-through rate. And also their video account, their ad load is still very low, right? Low single digit. They can increase it to mid single digit, or if you look at Douyin, they can do 12%. So there's still a lot of room to increase that. They have not done live stream e-commerce, which can further drive the advertising revenue. So they still have a lot of maneuvers which they can drive the ad growth there. Fintech, unfortunately, most of the revenues come from payment, which tie directly to the consumption activity in China. Transaction volume is still very solid, but people consumption downgrade, so the value is lower, so that slow the fintech revenue growth.
We're marking those lines of the pre-market in Tencent now. We're actually seeing it downside about 2% or so. I was going to talk to you about maybe more of the cyclical plays, which is probably the likes of Alibaba, JD, that report later on today, Elinor. Obviously, the consumption downgrade has weighed down on these names, but are you seeing some sort of maybe clarity now that maybe these incumbents are fighting back market share and able to actually claw back?
Yeah, so the weak consumption has weighed on all the e-commerce stock in China across Baba, JD, Kuaishou, all these platforms. Baba has reinvested in their Taobao app, increasing the user growth, increasing content, also attracting more low-price merchants on the platform to attract users. With the reinvestment, they are able to re-accelerate the GMV growth to double-digit in the first Q and high single-digit in the second quarter. Monetization rate is still lagging compared to the GMV growth. Revenue growth may be slower because the low price merchant only pay for ad spend instead of commissions. But however, they're rolling out more ad technology like full platform marketing solution, which can improve the ad targeting in the second half, improve the monetization rate. And they're also raising the technology fee by 0.6%. That could also improve the monetization rate in the second half. But for the second quarter, we still see a slower top line growth and the reinvestment may weigh on the margin. But for the December quarter, we may see a better top line growth, regrowth of profit. And also the company is doing massive share buyback, $3 billion a quarter, and they will probably be able to include in the Stock Connect in the September. All these will be a good catalyst for the stock.
Elinor, thanks for joining us. Elinor Leung, there, head of Asia Telco and Internet Research at CLSA. I just want to recap some breaking news that we got. So we're not going to get that MLF rate here today. That expires today. They mentioned they will be renewed on August 26th. We have to wait another 11 days for that announcement. We'll continue to watch markets. And, of course, home prices coming up in just about 7 minutes' time. Plenty more ahead. This is Bloomberg.
Right, welcome back. In a couple of minutes, the home price numbers are coming through out of China. New home prices, what you're looking at here is a chart that shows you red, the number of cities among the 70 that are seeing price declines. Gray unchanged. The green, of course, is the opposite. 68 cities out of 70 actually showed declines in June. So there's a possibility we'll see what the numbers come out. We could see actually 69 or 70 cities or all cities surveyed that actually see price declines. Numbers come out in a couple of minutes, Yvonne.
Yep, in terms of stocks to watch, Tencent shares, obviously, just given we already see that downside of 2% in the pre-market. Alibaba and JD are up next as well. So is Lenovo. But you have also like Michael Burry raising their stake when it comes to Alibaba as well. We've got the Open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're counting down the open of markets. In just a few seconds now, we're going to get new and old home prices coming through here. And, of course, leading up to that big data dump in about half an hour's time. So just to recap, if you're just joining the show, there was no MLF decision here today. They pushed that to August 26th. So we have to wait another few weeks or so for that. But certainly right now, it continues to be a downtrend right now when it comes to A50 futures here. We talked about the CSI 300 getting back to the levels that we saw back in February.
Yeah, right around, I think, as we were coming out of the Lunar New Year.
Yeah.
So we've come all the way back to those levels. Volumes, in fact, have gone all the way back to the start of the year. Turnover in China's gone all the way back 5 years. So as far as the animal spirits in the onshore market, just to mark that important nuance, has, I guess in many ways, gone away in a very large way. And as you can see, 3,300 is now in play on the CSI 300. Moutai and some of your other big names, as you can see bottom of your screens, are seeing some downside there as well. In a couple of minutes, it should be coming any time now, in fact, home prices. We're looking at our screens. While we wait for that, also to mention, too, your 10 and your 30-year yield are continuing to see some downside today. So the bond rally, I believe this is now 3 days after, I think, 4 days of weakness. The open in Hong Kong, and the focus there is earnings. So you have Tencent, 2% down in the pre-markets. You have Alibaba, you have JD.com due out with earnings later today, among many other companies, by the way, that are coming out with earnings. Lenovo, China Unicom, among other big names, of course, coming through with earnings as well. We're down 1.3% on the Hang Seng Tech Index, and we are now getting home prices out for the month of July. We are getting a decline of about 0.65% month on month. That is slightly better, quote unquote, than a negative 0.67% print. But I think that's now, how many months now that we're looking at declines here? 14 straight months in terms of year-to-year declines here. In terms of new home prices. Existing home prices also out. We're looking at steeper drop there, 0.8%. So both are actually coming in slower than the declines we had in June. If there is a silver lining, that's probably it at the moment. Some other data coming through as well here.
Yeah, Aussie jobs, obviously we talk about this a lot, but actually quite a sizable beat here today. We're talking about 58,238 jobs that were added in July month on month. The estimate was for a 20,000 print. So you're seeing basically the Aussie dollar reverse some of the initial losses. We're seeing a little bit of a spike up when it comes to that currency here this morning.
Okay, let's get a sense now of the broader policy prescription, assessment, diagnosis of the weakness in the Chinese economy, and certainly what policy prescriptions are probably needed at this point in time, given where the economy is. Joining us now is Economist Keyu Jin. She's also the author of the new China Playbook, Beyond Socialism and Capitalism, joining us this morning out of Hangzhou. Keyu, good morning, and thanks for making the time and for joining us right now. I mean, in about 30 minutes' time, the National Bureau of Statistics will be giving us the July numbers, and largely expected to show still a soft print across most parts of this economy. A lot of people are wondering, economists included, why monetary officials have not done something more aggressive to address the demand side of this equation. What do you think?
Well, I think there is a conviction, a belief at the very least, that the effectiveness of monetary policy is much reduced compared to many years ago, and that the overall economy is no longer very sensitive to interest rate cuts. So on the expansion part, of course, fiscal policy, there's still room, but as we all know, fiscal policy is also constrained. But I think looking at the broader issues here, first of all, the credit cycle that we experienced after 2009, I think in terms of reining in the financial system, reining in credit-driven booms, the government officials are very careful. There's now a much more emphasis, a greater emphasis on kind of almost like harnessing resources to go after the important things like high tech and innovation. And I think ultimately the belief that this kind of Keynesian demand-based stimulus, the solution to a big deficit in aggregate demand through monetary policy, I don't think there's enough conviction for that to work among the policy circles.
And from what we saw in the credit data, it's now fanning these fears of balance sheet recession. How big are those risks, you think, Keyu? And how do you actually determine whether China is in one or not?
Well, if you look at especially private companies, I think they are, and as has always been the case in the Chinese economy, suffering the most in economic downturns. There's almost a credit paralysis around, and some of this due to economic factors, but some of it is also due to more political economy-driven factors, where state banks, again, especially in downturns, are very, very reluctant to lend to private companies because they don't want to take the risk, and instead, of course, there's a bias towards the state companies, and of course, the capital markets are not doing well for the non-public companies as well, and so there's a definite credit squeeze, and it almost seems like there's an extreme kind of division in the economy where there are a certain number of firms that are doing pretty well in high-tech sectors or in manufacturing, export-oriented sectors, but then the majority of the firms are really seeing a struggle. And again, some of it is down to the proximate factors, which is real estate driving down investment and overall confidence, but a lot of it is also driven by this political economy reason.
Right. Okay, running the risk of oversimplifying what you just outlined is a fairly multifaceted and complex issue. What then is the solution here? Where would you start?
Well, first of all, China shouldn't be really practicing austerity during a downturn. If you're looking at wage cuts, or some certain aspects of increases in taxes, reduction in government spending, government expenditure. That is not really quite the policy prescription that the economy needs. Of course, local governments are fiscally constrained, but of course there's room in the central government fiscal space, reducing debt loads and spending on new infrastructure, on all kinds of ways to increase consumption and to offset the real estate investment contraction is very important. It's something as specific as let's take out a government-based fund, to deal with the pre-sold units of the ones that have come into trouble in the real estate sector to boost the confidence. There are a variety of ways to address these issues.
You mentioned what's really kind of the core of why we're seeing growth being hindered. Obviously, a lot of economists in your field talk about structural issues, whether it's demographics, the like. You're saying it could be politics. Can you flesh that out a little bit on why?
Well, the objectives have changed, right? This powerful economic engine in China worked really well when everybody's incentives were aligned. The local government officials were going after GDP and investment, and they were rewarded for taking a certain level of risk and being entrepreneurial. Now the objectives are things like, of course, broader social objectives, which are important, political loyalty, which is important, and geopolitical considerations, and so forth. But this model really works when there's a singular focus. We can feel that there's now much reduced incentive at the various governmental levels, and therefore at the private sector level, of pushing forward the economy. When a country gives up the pro-growth agenda, that is when when politics drive the economy, we most certainly see a slowdown around the world and in history, in fact.
Okay. Do you think the recent moves, I get to your point there, the recent moves from the central government to take on a larger role in terms of economic policy, for example, taking on a bigger fiscal burden, the revenue sharing mechanism that they talked about a few months back. Do you think that goes in the same direction to address some of the issues and, I guess, misaligned incentives that are currently plaguing, of course, the transmission of economic policy? Let's put it that way.
Well, the question is, are the quantity of these stimulus, are they large enough? Have they come a little bit too late? But most at the core is, we kind of need a southern tour of 1992, Deng Xiaoping around the country, boosting the confidence, saying, going forth with economic reforms, putting economics back to front and center. And that's going to give the signal that that's what they're going to have to work on. Now, let me just add that there are social considerations also in the objective function, which is understandable. We don't like massive amounts of inequality, the environment, and geopolitical national security considerations. But look, if you're China, if you're going after trailblazing innovation, you're going to have to tolerate a few people getting extremely immoderately wealthy. Is that something a socialist country could tolerate?
So I got to ask then a very simple question. Your book is called The New Playbook. What is going to be the new playbook now?
The new playbook is that economic growth is not the only objective, and it's trying to foster a model to achieve almost impossible, which is to reduce the fallacy of the capitalist world with widening disparities and all kinds of anxieties and chaos. The question is how it's done. That's a question mark that few countries have really figured out. And China, in the new playbook, is trying to balance this kind of growth and inclusiveness and a variety of other things. But the model needs to evolve and adapt in order to achieve some of that.
Okay, let me ask you then a direct question. Do you think the economic planning structure is currently formed enough to be able to address some of the policy prescriptions that you laid out? What needs to change effectively?
Well, the model is very robust in scaling up. The model needs to change to be more flexible, to really increase internal demand, internal consumption. We need to rely on experts, real economic experts, to outline a consistent short-term and long-term path forward. The short-term is very important. The Chinese focus on the long-term, but guess what? We are currently experiencing a big drop in aggregate demand, and you need the kind of Keynesian stimulus to stave off the risk of a further economic collapse.
Keyu, very quickly, what doesn't worry you?
I don't worry about the demographic aging and structural problems, including the debt issues, because these are not fundamental what's at core. China has a good few decades of growth to grow, growth to achieve, if the reforms will continue. Look at the billion people in the rural areas, undereducated, underemployed, the service sector, only 50% of GDP. Of course, the technological innovation. There are lots of things to do. There are deep-seated, deep-pocketed reforms to undertake. If the objective is placed back on economic growth and reform, I'm very positive that China will be one of the greatest contributors to global growth in the coming decade.
Keyu, it was great to have you. Keyu Jin there, economist joining us from Hangzhou. And we're going to have plenty more coming up as well on the back of that data release coming out of China in just a few minutes. You can go to TLive Go, that's fired up and opening right now, where you can get plenty of commentary analysis from our expert editors here. This is Bloomberg.
All right, welcome back. A look at the yield curve in China, and we're looking at, again, a resumption in the rally on the long end, as you can see on your screens. Somewhat of note as well is the PBOC here offshore is issuing some renminbi bonds here. So just keep an eye, of course, on what that means for the currency, what it means for rate cut expectations, I guess, moving forward.
Yeah, and there seems to be no let-up in authorities' efforts to cool down this bond rally. Here's a look at what state media has been saying here in today's China Brief. The PBOC-backed publication Financial News says China will resolutely crack down on illegal activities that disrupt the government bond market. Front-page commentary says some institutions have lent out bond trading accounts and quoted prices that were significantly higher than market levels. It also warns of systemic financial risks from one-sided declines in long-dated bonds.
And a China Securities Journal report is again flagging the potential bond market's gyrations and volatility here. The article says a striking a balance between stable growth and preventing financial market risk will be a key factor. It also quotes experts with advice that investing in the bond market does not necessarily mean that one is able to easily achieve stable returns.
Let's dig deeper into this and China's efforts to curb this rally in bonds and bring in our Bloomberg Opinion columnist Shuli Ren with her latest column calling that this yield curve control in China, you say it's clumsy and could actually easily misfire. Can you explain?
Absolutely. So what's happening is that China's consumers are piling into the bond mutual funds this year. And we know the Chinese consumers are very skittish, right? After the stock market rout, the property market rout. And then, if they see that they're no longer getting the returns that they were expecting, they can pull out. And there can be mass redemptions. Like this year, bond mutual funds inflow doubled from last year, and a lot of the funds, they basically pile into 10-year, 30-year because they're offering higher interest rates, right? And then once you see the mass redemption, then the bond yield can actually spike. I mean, we've seen this before. After China abandoned COVID zero in 2022, government bond yield spiked, and then 1/5 of wealth management products, they literally broke the buck. Basically, their net asset value is less than the face value. And the people just fled. So they need to be very, very careful and not scare people away.
Well, the objective of wanting a steep yield curve is understandable because you want you want the banks to be able to come on board and be able to lend and lend profitably. They're starting to experiment, to your point, right? They're moving the corridor lower the curve. They're then threatening to sell on the longer end. Is it working, I guess, is the question there. How good is it working?
I'm just afraid that China's bond market, government bond market, is going to turn into its stock market. People just lose enthusiasm, right? We've seen that in Japan. Even in Japan, bond traders complain about the lack of liquidity after 10 years of BOJ's yield curve control experiment. With China, it's those admonitions, the opaque window guidance. I'm just afraid that the bond market is going to die just like the stock market.
What other parallels do you see with what happened in Japan and what could happen in China?
Well, I think Japan, at least, they respect open market operations. They respect market forces. They are very forceful in their way. They say, we're going to buy 10-year bonds at this range. Like, you cannot go beyond this range. And China is kind of timid in a way. The policymakers, they're not really willing to do it. They just use those very opaque tools. And the way you'll see is that the government bond yields are just going to be fake. And then this is the benchmark for everything in China, right? Local government financing vehicles, they are going to try to issue bonds in the credit market. And then people are just going to say, if the benchmark is not real, I'm not going to buy anything there.
Shuli, thank you so much. Shuli Ren, our Bloomberg Opinion columnist. You can check out her column on the terminal and also on the website. We're looking at cash markets up on a CSI 300, 0.5% declines across some of the benchmarks in Hong Kong, pulled down by Tencent. As you can see, HS Tech down over 1%. This is Bloomberg.
Well, New Zealand's central bank says it now intends to reduce rates at a measured pace after delivering a 0.25 percentage point cut on Wednesday. The RBNZ Governor Adrian Orr told us the cautious approach aims to ensure both positive economic growth and stable inflation.
We are very confident that headline CPI inflation is already within our 1 to 3% target band. Obviously, the data lags the official data, but all of our near forecasts say we're there, and that gives us great confidence that we can now start easing policy. The important things that we've been watching for have actually been around price setting behaviour, inflation expectations, and the path of the non-tradable domestic homegrown inflation components. All are now aligned with low and stable inflation being restored to New Zealand, and that's the outlook for the next couple of years. What that means is we can shift increasingly from a restraint position back to a more neutral monetary policy position. The official cash rate from 5.5 to 5.25 still remains quite restrictive. We see a neutral rate more around the 3% level. So that gives you kind of a scalar. At what pace would we want to get there? At a careful and measured pace to ensure that inflation expectations remain anchored at that 2% target rate. That is our single focus.
You mentioned the neutral rate. The OCR track from yesterday looks like it might have bottomed out actually above some of the estimates from the RBNZ for the neutral rate. Do you think if the recessionary conditions as forecast materialise, there might be a need for that to change? There might be a need for rates to push now below neutral to get the economy and growth back on track?
There are many things that are pointing in the right positive direction for economic growth. So, at this point, we see just the need to remove restraint rather than provide stimulus. There's significant investment activity that is needed in the country. There's a lot of different price pressures. So, at the moment, subject to no future shocks, which is always the assumption you make in a forecast, we think we are in a comfortable control position to remove the stimulus and let sustainable growth take place.
Governor, it's really interesting to see you really focus on inflation as the single focus. Also mention words like comfort and also being calm when it comes to these rate cuts. But I do wonder how much of the impulse also comes from concerns about the growth of the economy. I understand that you also forecast some contractions for the rest of the year when it comes to economic growth.
Yeah, it's all in the parcel. So without doubt, our confidence around declining domestic inflation is because we can now observe quite significant spare capacity opening up in the economy, something that has been absent since pre-COVID periods. So that spare capacity means inflation pressures are coming out, and that means we don't have to do as much monetary restraints. So that's implicit in our projections. In fact, we estimate a minus 0.5% GDP figure for the June quarter. That's still yet to be done, and about a minus 0.2 for this quarter, the one we're currently in. But beyond that, we see positive economic growth coming, and as we can be easing interest rates. So, growth without the inflation.
And that was the RBNZ governor speaking with Heidi and Sherry earlier on the Asia trade. Look at markets right now. So in case you missed it overnight, the WHO declared, of course, monkeypox emergency in Africa, and some of the related equities that traded in China are seeing some gains on the back, in the Asia Pacific to be more specific, on the back of that piece of news here. Flip the boards. We're also looking at steel and iron ore play. So in a couple of things, right? Steel prices in China are down to about 10-year lows. Iron ore is down to about 2022 lows. We've got a warning, of course, from one of the biggest, or the biggest, steel maker. Cities come out and also said that they're placing 3 stocks on a 30-day downgrade watch as far as some of these names are concerned. And, of course, we're also looking at earnings, too.
Yeah, so Tencent certainly has been the drag on HS Tech here today. We're pairing off on some of the losses, but we're still down about 1.5%. NetEase, though, is the sort of the counterforce there. But you're taking a look at Alibaba. We're seeing now declines of 2.5% leading up to those earnings. And Samsonite, there you go, 13% drop there. Their earnings in the second quarter didn't look too good for the market. They were basically hurt by weak sales in China. And we're seeing analysts continue to trim their estimates for 2024 in the next 2 years or so. And yeah, we're just seconds away from that data dump.
Yep. Forecasts on your left, June numbers on your right. The breaking news number is coming through in 5 minutes. This is Bloomberg.
Welcome back to the China Show. Here's a look, of course, at, just 43 seconds until that activity data is due here. And we're watching everything from what's been going on in the activity the data here, whether it's retail sales, industrial production, the like here. New home prices, yes, we extended the decline in prices, but it was a slightly slower pace in July. But the picture doesn't quite change too much here right now. But yeah, we're taking a look at the renminbi. Still holding at that strength that we've seen of late, 715 levels here right now ahead of that data, Dave.
Yeah, and I would imagine this would be one of the places we'd be looking for reaction apart from the equity market. This tends to be, of course, fairly sensitive, especially of late here, to just the sequential changes to the narrative in the Chinese economy. So a couple of seconds away from industrial production, retail sales, fixed asset investment, and the numbers are now out. Let me start with the industrial production numbers coming through at 5.1%. That's slightly below, if you could even call it below median, but that's still within, of course, the middle part of that bell curve, 5.1%.
Yep, and if you take a look when it comes to retail sales, that was actually a slight beat. So some better than expected numbers there, 2.7% growth. The street was looking for 2.6, and we're seeing a little bit of improvement from the previous month of 2%. So maybe the consumption side of things looking a little bit better during the summer travel season. We're still watching fixed asset investments. That was a little bit of a disappointment there. We're talking about 3.6% for fixed assets, and property investment continues to be weak. We're talking still about a 10% drop there, Dave.
Yeah, we're looking at that. That's a negative 10% print. Of course, that is a year-to-date number. And it goes into, by the way, in case you missed it, half an hour back, we did get home prices for the month of July. New, that Yvonne is alluding to, new and used home prices actually still fell, but the drop is starting to ease. And certainly our headline, when you look at it, is that maybe, just maybe, we are starting to see some of the rescue efforts the government has put in place start to show up in the numbers. Of course, you take a massive step back, and these numbers are slower overall compared to the averages we had in the first quarter of the year. The jobless rate, though, actually ticked up, right?
So 5.2% when it comes to that. So it is ticking up by about 0.2%. You're taking a look at the renminbi. It looks like we're still holding on to some of these losses here after what has been, you can clarify basically, is a bit mixed, a mixed bag here when it comes to this data here right now. So there you go. Live presser coming out from the Bureau of Statistics here this morning. We'll see if we flesh out any sort of lines coming through from there. But in the meantime, let's bring in our China correspondent, Min Lo. Overall, run us through these numbers. What does it tell us?
Yeah, I mean, the numbers came in quite close to the estimates, at least within the range of the forecast. And again, we're seeing this two-track recovery in place. Industrial production growing at 5.1%. That is, by the way, the fourth consecutive month where we see the growth coming in at a slower pace. So some headwinds there. We saw that PMI, Caixin manufacturing PMI, contracting for the first time in 9 months, suggesting headwinds when it comes to export growth. And then retail sales coming in at 2.7%, slightly slightly beating the estimates. But as you said, there is a summer travel season where there is more demand for services. There is a favorable base effect at play here as well. But if you look at the goods, sale of appliances, sale of cars was down in July, and that makes up 10% of retail sales. So the sentiment is not really there, especially if you keep in mind the jobless rate increasing by 0.2%. So that's going to keep, consumers holding tight to their wallets here.
We also got some home price numbers, and a rate decision that was supposed to come in the last hour, we now know, of course, is taking place in 11 days.
Yeah. The home prices, well, it was not very optimistic. Again, I think the new home prices was 14th straight month of decline now, and for used home prices is the 15th straight month of decline. And I think PBOC had a quarterly survey where they found that nearly a quarter of the respondents believe that home prices will continue declining for the next 3 months. So it's going to be a downward spiral, right? Because if you believe home prices are going to decline, you're not going to go in and buy now. And then we have our Bloomberg Economics team coming in yesterday to say that there is 48 million of these homes that were pre-sold but are not yet built. It would take like 8 years to build them. So that's not going to increase appetite for pre-sold homes as well. So you're seeing a shift of demand towards the secondary homes, but even then that price declines is continuing to go on. Analysts are saying that the sector is still struggling to find a bottom here, and that 300 billion yuan in relending facility that the PBOC has injected to get SOEs to buy back these unsold homes, that's not seeing a whole lot of take-up rate either. So don't know when we'll see the bottom of this.
Oh, patience is a virtue.
Yep, Min Lo, thank you, our China correspondent there. I'm really talking more about these numbers. You can go to TLive Go for plenty more analysis and commentary from our team here this morning, still talking about this uneven recovery in July right now. Let's bring in Tai Hui, APAC Chief Market Strategist at JPMorgan Asset Management. It seems like the macro narrative continues to dominate this Chinese market, too, in some ways, too.
Absolutely. I think if you look at some of the recent company results, which I think a lot of tech companies have improved on their operational leverage, delivering decent earnings performance. But at the same time, if you look at the market reaction to these companies, have not been as strong as you would expect. I think still the macro narrative is dominating investor sentiment. Even though at the corporate fundamental level, things are starting to improve. So I think a couple of things. I think investors are still looking for more aggressive policy support to the economy, which we're still not getting. And secondly, of course, as we run up to the U.S. presidential elections in less than 3 months' time, how does U.S.-China relations evolve? I think that will be dominating investor sentiment, at least for the near term.
See, I mean, just looking ahead to the next few months, right? So you mentioned the U.S. elections. It doesn't look like on the data front things are going to make a substantial turn to the upside. Do you project that the opportunities that have done very well in China, the trades that have done very well, dividends, banks, what have you, will remain the dominant themes moving forward? In other words, does the rest of the market remain hostage, if you will, by the next few months?
I think for the time being, yes, because ultimately you don't have a significant international participation in the Chinese market at this point in time. So the retail markets in China or retail investors in China continue to dominate the scenes. And what do they need? They need income. They need less volatile stock price movement, which a lot of these state-owned companies, banks, telecommunications, energy tends to provide. So if you look at the stock level at the index level, it's not particularly exciting. But if you look at some of the state-owned companies, for example, the big four state-owned banks, they've delivered 25% plus return year to date. So there are opportunities in China. I think at least for the time being, until we get better macro data, that might continue.
But there's other opportunities out there, right? Take a look at how U.S. stocks are doing. We're basically back to levels that we saw. Same with Japan in some ways, too. It seems like markets are kind of just brushing it off what we saw last week. Do you think that's the right sort of way to go? And actually, are you telling clients to buy on the dip?
Well, I think I was away last week on holiday, so I missed the fun and game. But I think, again, being not in the market completely, I think it does help me to take a look from a distance. I think it's interesting how the market took one job numbers very serious, and they should. But at the same time, I don't think the economy in the U.S. is losing momentum as aggressively as the rates market is suggesting. In fact, if you look at corporate debt market, if you look at the equity market, they're still pricing in pretty respectable growth out of the U.S. So I think what we are recommending right now is for investors to start to take a bit more balanced approach between stocks and bonds. We still see opportunities in global equities, whether it's in the US or even in Japan or some of the selected markets in Asia. But at the same time, the US economy is gradually slowing down, so that should benefit investment-grade corporate debt as well as some of the government bonds.
How are you guys looking at AI with NVIDIA out in next week? There's some, the way the markets reacted to some of the reports a few weeks ago wasn't promising, and if that pillar goes, the index goes likely to.
Well, I think AI to me is still a very promising theme for the longer term, next 3 to 5 years. But I think investors are asking the right question, the healthy questions in terms of how are we pricing in too much growth for the short term, and also some of the challenges, for example, copyright issues, the consumption of power. I think very few people were talking about that until recently. Some of these challenges needs to be discussed as well. So there could still be some volatility with the AI-related themes, but to me, any consolidations or correction in the near term is actually interesting opportunity or entry points for longer-term investors.
You mentioned about a balanced approach. Are bonds sort of the good hedge now in this market? We're starting to see the correlations between stocks and bonds at least normalize a little bit, where that inverse relationship is coming back.
Well, frankly, stock-bond relationship hasn't been behaving it should be for the last few years. So I still think that as the Fed engage in rate cuts as soon as September, fixed income, whether it's government bonds or investment-grade corporate debt, they should deliver decent return to investors. But at the same time, we do need additional assets to help us diversify. For example, alternatives, whether it's in infrastructure or in real estate, where they generate income, where they have a low correlation with public markets. At the same time, I think a greater diversification geographically also makes sense. So, we can't simply rely on just one stocks or one index and one bond index to help us diversify. We need a more, sophisticated approach on diversification.
Would you say that in terms of winning strategies likely these next few months, is it a search for yield, for example? Is it more protection? Is there a case to be underweight equity markets given where we think the macro looks in a few months?
I do think the role of income will become more important because, if you look at the market sentiment right now, they are reading into every single bit of data with a huge amount of attention. Right. You've got elections coming up, you've got geopolitics, Russia, Ukraine, Israel, Iran, that could throw up some uncertainty. So I do expect the level of volatility to stay high. And therefore, the more consistent income cash flow generation, it is valuable. Now, the other way to think about how you manage volatility is for some strategy with embedded options opportunities where high volatility, you typically get a higher option premium. Again, in many equity strategy, when you do that, it does help to enhance the income opportunity as well. So I think when you are facing a high volatility environment, both income from traditional income generator like high dividend stocks or fixed income, that's great. But also I think some additional options, embedded strategies can also help.
So you mentioned about the markets maybe pricing in too many Fed cuts, right? I mean, what would be reasonable to you? And do you think the Fed's going to give in anything on what the market's saying right now?
I think the baseline right now is 25 basis points between September, November, December. That's the starting point. I do recognize that the market's pricing in 50% chance of a 50 basis point cuts in September. Obviously, we still have a couple of inflation and job numbers coming through between now and then. Right. But I think for the Fed to deliver 50, we do need a continuation of weaker data between now and then. Ultimately, they've been fighting inflation, and we are starting to see results, as we saw last night. But for them to suddenly change 180 towards cutting rates as aggressively as they were, hiking rates, we do need much weaker data or a much sharper market reaction between now and middle of September. So it is possible. But I think, the Fed needs to also manage its messaging and credibility after repairing itself from the inflation problems. They don't want to be seen as just running to the other side of the equation too quickly.
Tai Hui, thank you so much. Great to see you. Tai Hui there, APAC Chief Market Strategist at JPMorgan Asset Management. Just ahead here on the shows, we'll take a closer look here at what's happening in the steel sector in China. You have the top steel producer warning of a severe crisis in the industry, akin really to a harsh winter. The details on that story, plus what we're seeing in markets along those themes, just ahead. This is Bloomberg.
this does show that they continue to focus on this high-quality revenue streams, and games have accelerated further to high single-digit, and we've lifted our preference for games to the highest before the results season, and lowered internet verticals quite a bit, and then local services. This is our stacking order within China: internet games, followed by internet verticals, followed by local services, and therefore I do think the Tencent games revenues and the grossing trends lived up to expectations.
The Tencent second quarter result is quite solid. If you look at the online game, we see a nice rebound, and online game revenue will grow at 9% year-on-year in both domestic and international market. The gross receipt is growing even much faster compared to revenue, driven by the revived growth of the legacy game as well as the new hit games.
No. Some of our guests, they're reacting to Tencent's earnings. And of course, we take a look at Tencent shares are fluctuating, but we're basically pairing off some of the losses. Initially, it was a drop about 2%. So we're clawing back just a little bit, given it was actually a pretty mixed report, right? Robust games was certainly the big sort of positive, but then there was also the weakness in the fintech and cloud business as well. We're now awaiting numbers from Alibaba and JD.com as well. Let's get to our tech reporter, Annabelle Drewlers. She joins us now. So there's still a lot of bright spots for Tencent, too, in this earnings report.
That's exactly it. I mean, and it really, as you said, relates back to the gaming. It was the success of new titles that came out in the period, so things like Dungeon and Fighter Mobile, DNF Mobile, that's really been sort of the blockbuster hit of the summer in China. There was also legacy games as well that saw some strong growth figures when you look at things like the downloads and the revenue that's being generated. Internationally as well, or overseas growth, perhaps even better. We saw strong performance of PUBG Mobile, for instance. Esports picked up. Advertising revenue grew as well at around 19%. So lots of different things that were good in the numbers to take away. But as you said, that focus, particularly in Wall Street overnight, where you saw the stock dropping around 3%, not looking quite as bad so far in Hong Kong, but it does relate to the fintech arm, because that's really the biggest unit of Tencent, the fintech cloud services division. Slow growth there, slowest we've seen since 2022. And of course, a lot of the fintech it comes from the revenue comes from payment. You've got high transaction volume, but the transactions are worth less, and so you're taking less revenue from that. And that really points to the concerns around China's economy broadly.
Yeah, arguably, Alibaba and JD.com to come out with earnings today are more exposed cyclically because, of course, and their exposure to retail sales specifically, and expectations there for the two.
Yeah, absolutely. I mean, you could actually say, and you were saying in the last hour with Elinor, that Tencent is sort of like counter-cyclical. It's not so driven by what's happening economically. But what we do see is yes, as you said, Alibaba, JD.com, very much exposed to what's happening in China's economy, though we have seen as well Alibaba really putting a lot of investment back into its local platform to try and regain that market share. That could actually start to pay dividends in these numbers. JD.com, of course, also really feeling the heat. It's a very, very competitive landscape, and they've actually stopped spending as much on things like user perks. So they're more focused on profitability versus market share, but they could be trailing Alibaba. So they're two key ones to watch later.
It's interesting, we heard from Michael Burry as well, that the famed hedge fund manager actually increased his stake in Alibaba. A little bit of an out of consensus call in some ways.
Yeah,
out of the hedge funds,
of course, Michael Burry, person made famous for betting against the housing sector in 2008, but he actually exited completely from Chinese stocks back in 2022 or 2023. He's now re-entered the market at the beginning of this year, and in a really big way. He bought up big stakes in Alibaba, JD.com in the first quarter of this year. JD.com was the biggest holding, that's now flipped, and actually Alibaba is making up the biggest holding in his Scion asset management portfolio. Yeah, question, of course, is does that bet really pay off?
Okay, well, we'll see. Belle, thank you so much. Annabelle there with a preview and all the latest news on tech. From tech, we're moving to things like steel and old school industry here. So you have the biggest steel player in the world, and here's the warning coming through out of the chairman. Warning of this severe crisis, the world's biggest steel producer, sounding alarm about what they call an industry that's really facing a lot of headwinds here, one that has the potential to plunge the sector into a deeper downturn. Prices have already responded. In fact, when you look at things like rebar futures, as you can see, have fallen now to the lowest in about 10 years or so. We've put the producer price index as a whole in China at the bottom of this graphic to underscore really sort of the macro conversation, having a relative micro effect here.
Yeah, I mean, he mentioned that the downturn that we're seeing is almost as serious as what we saw back in 2008 and 2015, perhaps even facing a more serious sort of crisis right now. Let's ask that question to Bloomberg Intelligence Head of Asia, Metals and Mining, Michelle Leung. Excuse me, she joins us now. I mean, how bad is the situation right now, Michelle?
Right, actually, the whole industry has been suffering from overcapacity for more than a decade already. Previously, I mean, it has led to the industry consolidation, which makes things better. But then it comes to the property crisis as well as lower than expected infrastructure growth. So it's back in the loss-making situation. And we see that the building construction, which used to account for more than 40% of total steel, is still no way to come out yet. And now it only accounts for like around 30% of total steel demand. And on the other hand, infrastructure always keep at a high teen %. So we see a diverging trend, as you said, the rebars, which is the long steel, which is for construction, has come down a lot. Versus on the other hand, the flat steel was relatively better, but still not good. We see that the machineries and auto has been the only growing demand over time. And also we see that the steel mills margins, they are also being hurt by the higher raw materials costs over the years, as well as the higher decarbonization costs as well.
Yeah, since you mentioned margins, you know, if we're trying to figure out a timeline when the earnings come back and the profits come back for steelmakers, how long are we talking here?
I think it's still way too early to talk about a sustainable earnings recovery right now. We think the product mix also makes a difference, as I said, the rebar and the flat. And also steel mills have been shifting to produce higher grade of steels or higher strength steels. Like Bao Steel or CITIC stainless steel, they are producing special steels which earns higher margin. But after all, we see that the Chinese steel demand still going to contract by 2 to 3% after a 3% drop last year to probably the lowest since 2018. And we think it's hard to see a recovery because the raw materials price, although it has been eases lower, like coking coal or iron ore, but it's still hard to put it back into black. We need a very substantial cut in the production or either a pickup in demand, which either one is hard to see in the near term. Even the government has been encouraging the producers to cut their production, or the poor profitability is still didn't result in a meaningful cut in the production. We see in the first half it was only down by 1.1%, so which is not helpful at all.
All right, Michelle. Thank you. Michelle Leung there from Bloomberg Intelligence, Metals and Mining, telling us a little bit more about the outlook for the steel sector as well. In terms of analyst actions, that is probably one of the big focuses out of Citi and talking about these steel makers. And they're saying, you know, take a look, Baoshan Iron and Steel, that was one of the ones that they mentioned that put a downside 30-day catalyst watch by Citi. Samsonite, you take a look at what's been going on there. Their core earnings were not strong, really being dragged down by that weak sales in China as well. So that's been cut to neutral at Macquarie and Wuliangye as well. You talk about there from Morgan Stanley. They're talking about it's going to likely be the valuation is going to be capped, just given what we've been seeing in the liquors makers and the like of late.
Yeah, that's really been a pain point in these markets, right? And it's a story that hasn't turned just yet, right? So, we're going into the hour mark of the cash market session, plus, of course, in the coming up as well here, we'll be talking about some of the takeaways from this press briefing in Beijing. National Bureau of Statistics data dump just out. Suffice to say, plenty more ahead.
All right, just want to recap the big data dump that we just got at the top of the hour. And it was a mixed bag overall, but it was industrial production that did actually miss estimates and retail sales that actually did a little bit better than expected. But still, you're still seeing that two-speed economy. And yes, property investment still looking pretty bad right now.
Yeah, just breaking down some of the items because they've outlined some of the bright spots in this retail space. For example, sports items, plus 11%, communication appliances, that's mobile phones, plus 13%. So further breakdown of the data just ahead. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break, and we're still seeing a pretty decent day when it comes to risks there in Japan. Nikkei 225, as well as the topics, are punching higher by 1%. The yen's still on the weaker side, 147 levels here right now. No change on JGBs. But overall, it looks like things are still looking pretty calm out there when it comes to the equity universe. And as we start to continue to digest the breaking news that we got yesterday about the Prime Minister.
We thought it was a quiet day yesterday and that shocker of a news happened. In fact, the press briefing from the Prime Minister was exactly this time yesterday, which sets up a fairly unusually, maybe competitive race to replace the Prime Minister, Fumio Kishida, as the next one, of course. Whoever does win, of course, the LDP leadership will face challenges including inflation, volatile markets, this transition, of course, in the White House. Tobias Harris is the founder and principal of Japan Foresight and, in fact, joins us right now. And, Mr. Harris, first, we apologize for bothering you on your holiday, but when news calls, news drops and news calls, and thank you for being a good sport and joining us right now. You mentioned that it wasn't a surprise that it's come to this, but the timing was interesting. Just outline that view for us.
Well, I think, it was clear, I think, by the end of the diet session in June that Kishida was certainly facing an uphill battle for re-election, that he was facing, I think, a loss of confidence from within the LDP due to electoral defeats in the by-elections at the end of April. Just the mishandling of political reform legislation, I think, alienated a lot of his support within the party, perhaps most notably former Prime Minister Asotaro. And we saw over the subsequent weeks that, his approval ratings really haven't moved all that much, deeply underwater. I think LDP lawmakers have been hearing all summer from their constituents that it was time for a change. And I just think there's a mood that the public really has lost faith in the LDP. And we heard from Kishida yesterday that, really there needs to be a dramatic turnover in the LDP to reconnect and regain trust. So it seemed that Kishida was going to have a hard time, and yet he was still clearly trying to find a way to survive. And frankly, a lot of the contenders he was likely to face in a leadership election were all flawed. So it seemed he still might have had a path to survive. So that's why it's a little surprising that he acted now to leave the race.
And also surprising that, unlike what we saw in the U.S. with Joe Biden and endorsing Kamala Harris, we didn't see Fumio Kishida endorsing anyone to succeed him. Is this just going to be a free-for-all then?
That's certainly what it's shaping up to. And I think even before he left the race, he was inviting competition from several rivals already. And so without an incumbent prime minister in the race, the likelihood that you're going to see a number of candidates, assuming they can get the 20 nominations that they need to enter the race, we could see a very crowded field because a lot of people might have different ideas or different beliefs that maybe that this is their time to lead the party. You have several younger lawmakers who are considering that this might be a time to jump in. You have several lawmakers who've run several times before who think that maybe this is their last chance. And so that combination, I think, is resulting in an especially large potential field, I think, at this point.
Might this usher in any material change in both, either economic or foreign policy, given that, of course, this is simply just within the LDP?
Well, in broad strokes, I think we know the direction the LDP is going. Clearly, what we might call the Abe doctrine of prioritizing ever closer relations with the United States, drawing the United States into the region, making sure the U.S. is engaged, Japan security and Indo-Pacific security. That, I think, remains the top priority for whoever Japan's prime minister is. And then, frankly, that's from both parties. The progress in building relations with other partners in the region, most notably, I think, in recent years, the Philippines under Prime Minister Kishida, but in previous years, India, Australia, and so on. The ties with Europe, bringing Europe into Asia in new ways. All of that, I think, in broad strokes is going to continue. And I think in economic policy, the shift to what I think we can already think of as the post-Abenomics era, that has started, I think will likely continue. I think this LDP election is going to be useful in some ways for showing how far the LDP is prepared to move past Abenomics. I think we're going to see a much more fiscally hawkish LDP in the course of the next few weeks as the candidates debate. I think we've already seen, I think, that the LDP has moved in a more monetarily hawkish direction as the party has digested what the BOJ has done. So broadly speaking, I think the LDP is going to continue much as it has. But there's a lot of difference in terms of leadership style, in terms of the potential candidates' ability to control the LDP, the kind of image they're going to protect, what kind of decision makers they are. All of that, I think, is going to matter for their ability to actually get things done, to control a party that I think is just in a funk, is in a malaise, and is really unhappy with how things have progressed in recent years. And there's a lot of differences of opinion in how the party should be governed. And so whoever actually ends up winning is going to have to manage a kind of unhappy LDP, regardless of policy continuity.
Yeah, you talk about maybe the need for a generational change. I mean, can you name us some of the names? I know there's a few that we've shown. Yeah. Tara Kono, I think, Koizumi Shinjiro, some other names. I mean, what are some who do you think is probably best to kind of take over this now?
Well, I mean, this is the challenge that the LDP faces, and they don't. And the reason why I think at this stage it's really hard to identify a presumptive favorite is that in some ways the LDP has to square this circle where you need someone who is going to be appealing, who might actually show that the LDP is prepared to turn over a new leaf after some of the scandals in recent years, that it does want to communicate in a more forthright, direct kind of way. I think that was the wake-up call that I think every Japanese party got back in July in the Tokyo gubernatorial election, where Ishimaru Shinji, this small-town Hiroshima mayor, comes out of nowhere and finishes second in Tokyo's gubernatorial election. Clearly, there's a hunger for something new, for something different, and so the LDP is going to have to find a way to satisfy that. But the LDP is also a complex organization. It is an organization that is in just a very unusual period now that you have its factions in various states of decomposition, and you don't have them playing this organizing role. And Kishida, of course, took the step of calling for the factions to be dissolved. But the question of what was going to play the role that the factions have played in the LDP was sort of left unanswered. I think the implication was that a lot of that power was going to go to the prime minister, to the head of the party. And there's a lot of, even before that, there was a lot of opposition to centralization within the LDP under the Abe years. And so people weren't exactly happy with that answer. And the LDP hasn't quite figured out, okay, if not factions, then what? And that question is going to take someone who's really, I think, has really dense relationships within the party, is just a really skilled operator within the party. And that skill set might not necessarily be what makes someone a successful, appealing candidate to the public at large. And so resolving that tension between those two needs is, I think, going to be really difficult.
Tobias, we all leave it there. Tobias Harris, founder and principal of Japan Foresight. Go back and enjoy your vacation. Thanks for joining us here this morning. From one country and political uncertainty to another one that we're facing here right now, we're talking about Thailand. Its constitutional court has dismissed the Prime Minister Srettha Thavisin from office after finding him guilty of an ethics violation. Let's get to our Bangkok reporter, Papicha Tanaka-Sampipa. She joins us now. What happens now?
Yes, Yvonne. Now that SETA is out, Thailand is again without a leader, and we are entering a new period of political uncertainty so soon after a general election last year. But the good news is that the process to select a new prime minister has already begun, and the House of Representatives is scheduled to meet on Friday morning, essentially tomorrow, to pick a new prime minister. Now, to recap, there are 6 candidates who are eligible to become Thailand's new prime minister, and it is expected that SETA's Pheu Thai party will try to retain the premiership. And that is why it's very imperative for Pheu Thai today to bring the coalition parties to the negotiating table and ensure that it can win the premier vote in one go tomorrow to set up a government as soon as possible.
So we put this question to our previous guest in the previous segment on Japan, but in Thailand's case, who is expected to be nominated now for PM?
Yes. David, the Pheu Thai party is right now having a meeting as we speak among its lawmakers, and it is expected that it will confirm its nomination for 75-year-old former Attorney General Shaikasem Nittisiri later this morning. Pheu Thai still has another eligible prime minister candidate in Paetongtarn Shinawatra, the leader of the party and daughter of former Premier Thaksin Shinawatra. Now, we have to wait and see later this morning if there will be any challenges among the coalition parties to this to Pheu plan for Chai Khar-saim's nomination. If there is, then we might have to watch out for another candidate from outside of Pheu, which is expected to be Anutin Chanvirakul, or the leader of the current second largest party in the coalition, Phum Jai Thai Party.
And, I mean, the big question is, what's the state of this coalition? Are they likely to stick together now?
That's a very good question, because the successful prime minister candidate will need more than half of the support from the lawmakers in the lower house on Friday. And that will be a huge test of unity for this current coalition. Mathematically speaking, this coalition needs to stick together if it wants to stay in power, because otherwise the only other option would be to break up and join hands with their common enemy, which is the opposition People's Party, which doesn't sound unlikely at this stage. Now, if there is a lack of unity within the coalition, that risks prolonging this current period of political uncertainty, because if Chai Khar-saim or Pheu nominee does not win an outright vote tomorrow, then the lawmakers will have to convene again and vote on potentially a new nominee, which could take days or weeks to conclude until we have a clear winner.
Our Bangkok reporter there, Patpicha Tinakasampipat, on the latest on these these gyrations in the political scene there over in Thailand. Right. So one market that is, of course, shut today is India, and we'll take you straight now, of course, to this the Independence Day speech from the Prime Minister Narendra Modi. He is speaking, of course, in Delhi, and certainly one of the things that has come out so far, unsurprisingly so, is that India remains committed to reforms to strengthen the nation. So we'll leave you with these live picks, and of course for our Bloomberg subscribers, you can continue watching this speech. It's on Live Go. You can also find other big diary entries coming up today and later this week, as well as some of the events that, in case you missed them, might have also been part in that space. Plenty more ahead. This is Bloomberg.
और इसके लिए मुफ्त इलाज की योजना हमारी चल रही है। बिजली, पानी, गैस अब सैचुरेशन के मूड पर, और जब हम सैचुरेशन
Right, we're about 17 minutes into the cash market session, about 40 minutes into this ongoing press briefing out of the National Bureau of Statistics. On the market side of things, we are looking at the best day for the CSI 300 so far this month. We're looking at volumes also picking up substantially. And of course, on the left side of your screens is economic officials. They're outlining, of course, the state of the economy in July.
Yes, they've been talking about the unemployment number that actually ticked up to 5.2%. They're saying, employment in China is still impacted by structural mismatch, and high temperature and rain is going to impact food prices in China as well. Those are going to be the latest sort of lines that we're getting. PPI prices may also fluctuate in the future months, but this is, of course, as you take a look at that data, it just shows that this is an economy that basically has failed to pick up after the worst stretch we've seen in about 5 quarters. And it really has been held back by the likes of consumption, for example. I mean, we did see that beat in retail sales, but we're still talking about a 2.7% print. And we're seeing more of that breakdown of what led to that number.
Yeah, things like jewelry, for example, didn't do well. Things like autos, not doing much just yet. Some of the staples like food and oil up about 10%. Other categories that are on the better side of things, the food is up. If it's just food simply, it's 10%, beverages plus 6%. Things like appliances, mobile phones up 13% year on year. So there are bright spots within broadly, of course, what's really been generally still a soft set of numbers. Let's get the initial take from our economics team here at Bloomberg Economics. David Chu joins us right now to talk us through how he interprets these latest numbers.
Still, we think that if we don't say it's bad, we say it's not so good. Because what actually worried about us is that we didn't see any clear signal that the activity is bottoming out. Still, for several months, China's economic activity have been in a sluggish range, and the government tried some policy stimulus to boost, but we didn't see any sign that it can go up from now.
How do you view the investment data? I mean, you're still seeing this investment slowdown, this persistent drag from property investment, and also a deceleration now, even in infrastructure investment.
Yes, it's worth of notice, and for us, I think it's an alert, because if you look at the data, which we just saw, is that in the supply side or in the production side, the industrial production has been above 5% year-on-year growth, which is okay, fine. But if you look at the demand side, the retail sales has been slow, has been weak for several months, and the infrastructure investment has been one of the major engine in the demand side, and it largely offset the sluggish investment in the property sector. But now we have seen the infrastructure itself slow down. It means that an engine of China's economy in the demand side is also moderating, losing steam. So it tells us, okay, the imbalance of the economy, which means a relatively stronger output side versus the weaker demand side, this imbalance is to be more and more in the future. So that it tells us maybe one day we will see the demand side, the weakness in the demand side will return to bite the output side.
Is the growth target at risk? Given, what my sense from what you're saying is, you look ahead, fast forward a few months, the growth drivers that have managed to get us this far start to go away. And does the PBOC need to do more? They've introduced, of course, this new policy framework that, they're moving the MLF, for example, 11 days from today.
Yes, I do understand that people are looking at the PBOC heavily because usually people think that the central bank should take the heavy lifter to stimulate the economy. But to be honest, at this stage, I think we should look more at the fiscal side, because if you look at the deficit target set this year, it was more than the original deficit target set last year. So you can see that the leaders, they tie a lot of attention to the fiscal side, hoping the fiscal investment can lift the economy, help to stabilize the growth. But so far, we think that the investment or the spending of the fiscal side is still lagging the target, and it lags what happened last year. So we think in the next couple of, in the remaining several months, we think the fiscal side needed to do a lot to help the economy. And for the PBOC, we still think that another rate cut is to come in 4Q. But the dilemma for the PBOC is that they're still waiting for the Fed.
Right. Okay. David, thank you. David Chu there, our Bloomberg economist, recapping that data for us. And let's switch gears and talk a little more about the RBNZ now, saying that it intends to reduce rates at a measured pace after delivering that 0.25 percentage point cut on Wednesday. The governor, Adrian Orr, told us the cautious approach aims to ensure both positive economic growth and stable inflation.
We are very confident that headline CPI inflation is already within our 1% to 3% target band. Obviously, the data lags the official data, but all of our near forecasts say we're there, and that gives us great confidence that we can now start easing policy. The important things that we've been watching for have actually been around price setting behaviour, inflation expectations, and the path of the non-tradable domestic homegrown inflation components. All are now aligned with low and stable inflation being restored to New Zealand, and that's the outlook for the next couple of years. What that means is we can shift increasingly from a restraint position back to a more neutral monetary policy position. The official cash rate from 5.5 to 5.25 still remains quite restrictive. We see a neutral rate more around the 3% level. So that gives you kind of a scalar. At what pace would we want to get there? At a careful and measured pace to ensure that inflation expectations remain anchored at that 2% target rate. That is our single focus.
You mentioned the neutral rate. The OCR track from yesterday looks like it might have bottomed out actually above some of the estimates from the RBNZ for the neutral rate. Do you think if the recessionary conditions as forecast materialise, there might be a need for that to change? There might be a need for rates to push now below neutral to get the economy and growth back on track?
There are many things that are pointing in the right positive direction for economic growth. So, at this point, we see just the need to remove restraint rather than provide stimulus. There's significant investment activity that is needed in the country. There's a lot of different price pressures. So, at the moment, subject to no future shocks, which is always the assumption you make in a forecast, we think we are in a comfortable control position to remove the stimulus and let sustainable growth take place.
Governor, it's really interesting to see you really focus on inflation as the single focus. Also mention words like comfort and also being calm when it comes to these rate cuts. But I do wonder how much of the impulse also comes from concerns about the growth of the economy. I understand that you also forecast some contractions for the rest of the year when it comes to economic growth.
Yeah, it's all in the parcel. So without doubt, our confidence around declining domestic inflation is because we can now observe quite significant spare capacity opening up in the economy, something that has been absent since pre-COVID periods. So that spare capacity means inflation pressures are coming out, and that means we don't have to do as much monetary restraints. So that's implicit in our projections. In fact, we estimate a minus 0.5% GDP figure for the June quarter. That's still yet to be done, and about a minus 0.2 for this quarter, the one we're currently in. But beyond that, we see positive economic growth coming, and as we can be easing interest rates. So, growth without the inflation.
Yep, our conversation earlier there with the governor of the RBNZ. Plenty more ahead. This is Bloomberg. Right, Citi downgrading Chinese steelmakers, taking these three that you see on your screens here, putting them on a 30-day downgrade watch, given, of course, the broader structural challenges in this sector. Earnings, that's the other thing we're tracking to as well. Tencent has reversed most of the early weakness on the back of earnings reported yesterday, and coming up on deck, of course, is Alibaba today. Samsonite also, speaking of downgrades, also getting one, of course, and this drop in profits hurt by, of course, the business in China. That stock is off the rails, 13%. That's it from us here on The China Show. Bloomberg Markets Asia is next. We'll see you all on Friday.